Good afternoon, everyone, and welcome to TradeStation. One of the things that we know we have to do each year is talk about tax treatment for our trading profits. Hopefully, we have some after the last couple of trading sessions. I'm sure some of you have done very well this year. Yes, there is an echo. Thank you. Our presenter today is Mr. Robert Green. He's the CEO of Green and Company. I'm going to let him introduce himself as the presentation goes on. Mr. Green develops and leads tax strategies, including the TraderTax niche for his company, Green, Neuschwander, and Manning, the CPA firm. Mr. Green performs most of the client consultations and entity formations. He's also involved with tax controversy, including IRS and state exams, appeals, and tax court. He also co-manages many operations for this CPA firm. He is quite an expert on this field. He has been consulting with many brokerage houses. We're very happy that he found time to do this presentation for us here at TradeStation. Now, our presentation is for educational purposes only. All the symbols, all the trading ideas, and anything that might come up in the course of this conversation is for demonstration purposes and not recommendations. Remember that this is not an offer or a solicitation of any kind anywhere where TradeStation is not authorized to do business. Remember that active trading is not suitable for everyone. Options trading does also carry a high degree of risk. It may not be suitable for all traders. I've included in the chat panel a piece of disclosure information regarding the characteristics and risks of some of the asset classes that we cover here at TradeStation. That may or may not be the focus of our presentation today, but it sure is a good idea for us to bring about for you. I urge you to, when you get a chance, to go to the TradeStation Market Insights page. It's full of our information. The research and our blog, the Market Insights blog, is full of market content of different observations from different authors that are employed here at TradeStation. And we have been very active. It's been getting a lot of feedback and good feedback, and certainly got a lot of traction in the industry. We urge you to take a look at it when you get time. Certainly not during our presentation today. Now, you should also consider this. If you're in the Chicago area or would like to be in the Chicago area on October 19th, we are offering the TradeStation Option Stars Conference, where you can learn how to trade from the pros to trade options like the boss. Go to tradestation.com/optionstars for the details on this very incredible event where you can learn how to jumpstart your option trading. So with that all out of the way, let me bring in Mr. Robert Green, the managing partner and founder of Green and Company.
Thank you, Don. Sorry for the echo, folks. I think it was my speakers because I had trouble getting it to recognize my mic speakers. Anyway, hopefully there's no echo now. And Don, are we all set to move forward? Okay. This is the 2018 tax treatment overview for traders. And this is post-tax reform, so it is up to date with the latest law. I'm Robert A. Green. I'm a CPA and managing member of Green, Neuschwander, and Manning, and CEO of GreenTraderTax. Don did introduce me before. I also write the annual Trader's Tax Guide every year since 1997. It's updated for the latest Tax Cuts and Jobs Act impact on investors, traders, and investment managers. I'm also a contributor to Forbes.com, and you'll see my content on leading brokerage firms and media. Let me keep moving the screens here. This information is educational. It's not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Robert Green and Green Companies, that's me. We're not affiliated with TradeStation. We are a CPA firm. They're a brokerage firm. So today we're focusing on the tax treatment for various financial products, securities. They're different from options and futures and ETNs, ETFs, foreign futures, precious metals, cryptocurrencies. Securities have wash sale loss adjustments, other instruments don't. You might be a trader and make a mark-to-market accounting election. It all makes a big difference for the following reason. For example, the last few days, the market sold off a lot. I'm going to get calls next week. How do I handle some large losses that I have? And if it's a capital loss, well, maybe you need trader tax status in a 475 election for it to be an ordinary loss. Capital losses are nice. I mean, capital gains are nice if they're long-term, but most traders have short-term capital gains. Yet they're stuck with the capital loss limitation. They're stuck with wash sale loss adjustments. So is it capital? Is it ordinary? Is it a security with wash sales in 475 or not? It covers the gamut. You'll see there's a lot of different tax treatment. Your 1099-B does not cover all this. It's written for the everyman. A lot of local accountants don't understand all these rules. So you need to master the tax treatment to get what you're entitled to in the tax code and to avoid the pitfalls. So first we're going to talk about securities. They need to watch out, securities traders need to watch out for higher tax rates because it's the ordinary rates on short-term capital gains. Those dreaded wash sale loss adjustments when you get the 1099-B at year end and it says that instead of paying taxes on $100,000, the IRS wants you to pay taxes on $150,000 because some losses that you had in December, they want you to defer them until January. And that's a nasty surprise. You want to know ahead of time. I have a wash sale problem in the following symbols, 2 out of 10 symbols that I trade. I'm going to break the chain. I'm going to sell it, not get back in for 30 days, and not have a wash sale loss deferral. You also, it's a nasty surprise to learn about that capital loss limitation. It's only $3,000 against other income. Capital losses are unlimited against capital gains, but they're limited against other income. It's never been indexed for inflation. That's so unfair. So the IRS tells you, you make money, pay taxes. You lose money, you might have to defer your loss to the next year when you may struggle to use it up. Sometimes people don't want to cash out of positions, pay a lot of taxes, then get back in and have a capital loss the next year. Now with securities, there are also accounting challenges with the wash sale loss adjustments, the line-by-line reporting. So you can see securities, there's a lot to digest with securities. This is what they include. They include equities, otherwise known as stocks, whether they're US or foreign equities. Equity options, stock options. Narrow-based indexes that may trade on a futures exchange, but it's made up of 9 or fewer underlying securities. There are only a few of those. Most indexes are broad-based, like the S&P, the NASDAQ, the Russell. They're made up of 10 or more, so they're not a security. They're a 1256 contract, which we cover next. Now, options on the narrow-based indexes are also securities. Exchange-traded funds, ETFs, if they're structured as a registered investment company, a RIC, securities ETFs are registered that way, those are securities. Options on those securities ETF structured as RIC are securities. Exchange-traded notes, ETNs, only if they're structured as a debt instrument. Most are not. Most are structured as prepaid forward contracts like the VXX, the most popularly traded ETNs, like those volatility ETNs, which are in vogue right now the last few days with the great volatility in the markets. Prepaid forward contracts are not securities. That has a lot of implications, folks, because if you take a big loss in the VXX or the inverse product of the VXX, I mean, the VXX probably jump, but the inverse probably drop, and you have trader tax status in 475, you're out of luck. You can't get ordinary loss treatment. But if you're trading one that's a debt instrument like UGAS, it can fit into 475. Again, there's a lot of different boxes on the tax treatment. You got to know what box you're in to know what tax treatment you're going to get. We've had a lot of clients contact us, and some are very disappointed to learn that what they were counting on is not the case. Others are thrilled to learn that they can do things they didn't know they could do. Again, securities also include bonds, mutual funds, and single stock futures. Now, when you have securities, like your equities, there's short-term versus long-term capital gains and losses. And for most investors, the everyman, they buy and hold Apple or cryptocurrency or whatever, tech stocks, FANG, and they've enjoyed tax deferral at year end because they had the default realization cash method. They don't report a capital gain until they realize it, until they sell it. And so they can defer it at year end. And that's a great thing. Now, also, if you hold it open for 12 months, you get that lower long-term capital gains rates. Otherwise, the short-term capital gains, they're taxed at the ordinary rates. And with tax reform, they currently go up to 37%. If you happen to hold for 12 months, the long-term rates apply. It's 0% in the lowest brackets. Otherwise, all the middle brackets are 15%. And the top bracket is 20%. That long-term capital gains rate is a great benefit. The tax code is written so that if there's an incentive, there's a way to pay for the incentive. So you pay for the long-term rate with wash sales, capital loss limitations, higher rates on short-term. But a lot of traders don't have a lot of long-term capital gains. They're day trading and swing trading. Some have segregated investment portfolios. Now, when it comes to securities, you always have to watch out for the wash sale loss adjustments. Congress doesn't want taxpayers to realize tax losses that are not economic losses. If you close a securities transaction, you sell it, but you reopen it right away. In the eyes of the IRS, they don't think you've economically closed a position. Yes, you have closed it officially, but not economically. They want to string it together. So they want you to defer the wash sale loss to the replacement position. If this happens at year end, many taxpayers, at year end, many taxpayers do tax loss selling. They say, well, I have 50,000 or 100,000 of capital gains this year. Maybe they got washed out the last few days. They sold before the market dropped too much. They realized some big capital gains over the past few years. And then going into year end, they say, what can I do to cut my taxes? Well, I can do tax loss selling. I can sell out some of the unrealized losing positions. And then I'll get right back in January to catch the start of the year rally, which you might have in January. Not necessarily. That would be a wash sale. And they would have to defer the December loss until January purchase because they bought a substantially identical position within 30 days before or after taking that loss. 30 days before or after is an eternity for day and swing traders. No, I'm not done yet, folks. Wash sales are very confusing. There are different rules that the IRS has for brokers versus taxpayers. This is not widely known, even though I've been talking about it for years. Brokers don't want to necessarily harp on this issue. They're following the rules for brokers on the 1099Bs. Most local accountants just want to use a 1099B. TurboTax wants you to import a 1099B. People in the very small fine print might mention this problem, but it's potentially a big problem that I'm thinking one day could come crashing down on many traders when the IRS decides to audit over it. And here's what I'm talking about. Section 1091, the wash sale loss rules, require taxpayers to calculate wash sales based on substantially identical positions, which means between the equity and equity options at different expiration dates. If you only trade equities and you don't trade equity options too, this part of the problem doesn't affect you. Another part may. So that's different from the rule for brokers that require identical positions, the same symbol. So the broker will calculate WAR sales based on, let's say, Apple stock only. But you're supposed to calculate it based on Apple stock and Apple options at different strike dates because those are substantially identical. Apple and Google are not substantially identical. Now, there's another difference with what I call apples versus oranges. Brokers calculate WAR sales per the one account. That's all their software can do. But the IRS wants you to calculate WAR sales across all your accounts, including IRAs. Let's say you have an individual account. Your spouse has an individual account. You have a joint account. You have an IRA. Your spouse has an IRA. You have a Roth IRA. They want you to calculate WAR sales across all those accounts because it would be too easy for you to game the system otherwise. And they just don't want you to game the system, booking losses and getting right back into positions. So you need to avoid these WAR sale loss conditions between taxable and IRA accounts. Consider a do not trade list to avoid permanent WAR sale losses between a taxable and an IRA account. For example, you trade tech stocks in your taxable accounts and you trade energy stocks in your IRA. Otherwise, it's a permanent WAR sale loss, catastrophic. You can never report a WAR sale loss with an IRA. You take a loss in your taxable account within 30 days before or after. You buy back the position in your IRA, including Roth IRA. The taxable account can't take the loss. And there's no way to record the loss in the IRA. It's a permanent loss. Otherwise, if you're not trading your IRA accounts, you just really want to avoid WAR sales in your taxable accounts at year end. Let's say you've had WAR sales all year long. Don't panic. You have a chance to clean all this up going into year end. You can break the chain on WAR sale losses at year end in taxable accounts to avoid WAR sale loss deferral to next year. So if you've made 100,000 going into December and you've had some WAR sale losses during the year that go into December because you keep buying it back, break the chain means sell it and just don't link it to another purchase within 30 days. Wait 31 days so there's no linkage and you break the chain. So as an example, you sell XY equity on December 20th, 2018 at a loss, and you don't repurchase XY equity or an XY equity option until January 21st to avoid the 30-day window. WAR sale loss accounting is way over the head of the local accountant to deal with. It's way over your head to spot manually. Your 1099-B does a great job, but they're following different rules for brokers. It's not a complete set of rules. If you only have one brokerage account and you only trade equities, you can probably rely on the broker's 1099-B, but if there are multiple accounts, you and a spouse filing married IRAs, and or you have securities and options, you need another solution. And that's where we recommend the TradeLog software, which we happen to use in our trade accounting service, but you can get a retail license to TradeLog and do it on your own. So you'll download all your trades into the accounting program right from the broker. You're not going to download the 1099-B because that's already been aggregated under apples versus oranges rules, and it's already not what you need if you have divergence of apples and oranges. So you download the trades, it calculates the WAR sale loss adjustments in an IRS compliant manner, and it generates it separates 1256 contracts from the securities, generates your Form 8949 capital gains and losses. For your 1256 contracts, it generates the 6781, and then you have the totals to enter into your tax software or give the account. And you can reconcile it to the 1099-Bs. And it gives you that potential WAR sale loss report in December so you know what to avoid. So don't panic on wash sales. You have the problem with the IRA, stop it with the do not trade list. For the taxable account, break the chain. Get on top of wash sales. Don't put your head in the sand about it. Now, Section 475 is a wonderful election. It exempts you from wash sale losses and the capital loss limitation, but you got to be a trader that's eligible for trader tax status, and you have to make a timely Section 475 mark-to-market accounting election, which was due by April 17, 2018 for 2018. It's now too late. If you set up a new entity, the entity can elect 475 within 75 days of inception, but you better get that going immediately, because if you start by November, it's getting too late in the year to do all that. So again, 475 exempts you on the wash sale loss adjustments. It gives you ordinary gain or loss treatment, so it's also exempt from the capital loss limitation. You have a big loss, you can write it off against your wages, your spouse's wages, any other type of ordinary income. Section 475 is a very powerful deduction. It also gives you that 20% pass-through deduction on qualified business income under the new tax law if you're not priced out of the deduction for a service company. We're not going to talk too much about 475 today because it's beyond the scope of today's presentation. I've covered that with the trader tax status presentations. So we've talked about securities. Let's move on to 1256 contracts. Section 1256 contracts, like your futures, your broad-based indexes, they enjoy lower 60-40 capital gains tax rates. 60% is the long-term capital gain. The rates are about 1/3 off. Trade 1256, you're saving a lot of money, whether you're a trader or an investor. There's summary tax reporting. You don't need that line-by-line reporting. There's no wash sale loss adjustments. The broker gives you a 1099-B, and yes, you can absolutely rely on it. There is no apples and oranges. You don't need a trade accounting program. Sounds simpler, and there's better tax. There's many different aspects to futures versus securities, and I'm not giving investment advice on what's best. You have to look at them. There's a lot of other factors. But tax-wise, the 1256 contract is superior. Now, it includes U.S. futures. Those are regulated futures contracts on a qualified board or exchange. Don't take anything for granted, folks. 1256 is like the special section of a club, the VIP section. In order to get in there, you got to have a ticket, and you will be bounced out of it without a ticket. And a lot of people think they're in, but they're not in. Some people think they're out, and I give them a ticket in. So it includes U.S. futures, options on those U.S. futures. What about foreign futures? Well, they need a CFTC approval for a no action letter, but they also need IRS approval for 1256, and very few foreign exchanges have that. We'll cover that more later. Broad-based indexes, these are the famous E-minis, the S&P 500, the NASDAQ 100, the Russell 2000. Basically what you do is you take a symbol, you put it into Google, you search the symbol, you look at the Yahoo Finance results. If you see a securities exchange, it's probably going to be a security. If you see a commodities futures exchange, it might be 1256, but you take a closer look. Is it an index? Because I already told you, the NASDAQ 100, the S&P 500 ETF versus the S&P 500 index, they're two different things. The index is 1256. The ETF, the SPY, is a security. They trade a similar index, but one is an index, one is an ETF. And you'll see that it says security trading on a securities exchange. And you have to go even deeper than just that. If it's an ETN, you got to look in the prospectus for some additional clues. Or just check our content, because we do cover most of these things. So your broad-based index is made up of 10 or more underlying securities, S&P 500, NASDAQ 100, Russell 2000. Those are all more than 10. But the SPY, the ETF, that's more than 10, but too bad, it's not an index, it's an ETF. So let's get off of that divergence. Now, if the broad-based index is 1256, when it comes to options, usually the option is a derivative of the underlying. In this case, the option on the broad-based index is also 1256. The options on the futures, 1256. Now something totally different. Forex contracts. If you're trading forwards, most people trade spot. With forwards, you can opt out of 988 into 1256G on the main currencies only. We'll cover that more later in the forex section. You have an options on a commodities ETF structures at a publicly traded partnership. We think it's 1256. Now this is a big one. The next one, CBO listed options on volatility ETNs, whether they're structured as prepaid forward contracts or as debt instruments, VXX or UGAS. It's a CBO listed option. We think that is 1256. Even though your 1099B might list that as a security, we think it's a 1256. Most of the designations on the 1099Bs come from the exchanges, and they're not really giving tax advice. So there's a lot of confusion on certain exotic products, and I won't even call them exotic anymore. The volatility ETNs are very popular, and there's a lot of misinformation about them. Now, this next one is the big catch-all, your non-equity options. So a lot of people call something an option, and then they say, well, listen, it's not an option on a security. It's not an option on a stock. It's not an option on a securities ETF. It's an option on an index. It's an option on an interest rate future. It's an option on this, that, or the other. It's a non-equity option, but you got to do more work than just that. You can't get lazy. You have to look at the court cases. You have to other IRS guidance. That's when people come to us and our tax attorneys dig more. Now look at this next one, Forex OTC options. Few retail traders trade those, but Forex pros do have access to those. First, the IRS said it's 1256. Then they said it's not. Then they said there was a big tax court case in the right appellate court, said it is 1256. Went all over the map in terms of logic. And I've written about all these little things I've written about in blog posts. You can delve further into this in our guide and in our blog posts and in webinar content. This is more of an overview tax treatment webinar. Now, again, the Section 1256 contracts bring meaningful tax savings. 60/40 capital gains rates. 60%, including a day trade. You don't have to hold it a year. You can do a scalp day trade, and you're getting a 60% long-term capital gains benefit. The other 40% is the short-term ordinary rate. At the maximum tax bracket for 2018, the blended 60/40 rate comes out to 26.8%. That's 10.2% lower than the highest ordinary rate of 37%. And there are meaningful benefits throughout the rates. If you go to our website after this and click on Tax Center, Trader Tax Center, and then click on Tax Treatment for Financial Products, which has more information than we have in today's presentation, you'll see on the 1256 section that I have a worksheet showing you all the 60/40 rates. So you can see what bracket you're in and what your 60/40 rate is. And it's a meaningful benefit throughout the brackets, because in the lowest two brackets, the long-term rate is 0. Now, this is a loophole of sorts. I debated Warren Buffett on it in the New York Times. Andrew Ross Sorkin interviewed me about it. I had no idea that the other side was argued by Warren Buffett. The article was about tax loopholes. He was assembling a list to be repealed by Democrats. Warren Buffett thought 60/40 was a loophole that should be repealed. I argued why it should not be. You know, 1256 traders can never get a long-term capital gain. It's mark to market. So if you hold it more than a year, you can't get a long-term capital gain. Plus, professional traders have to pay self-employment tax. Online traders don't. But professional traders who are members of the CME with full privileges owe self-employment tax. So for that reason, Dan Rostenkowski, the infamous chairman of Ways and Means from Chicago, he negotiated 60/40. So I don't agree that it's a loophole that should be repealed. Traders need to fight to retain 60/40. It's mark-to-market accounting. It's on a daily basis. You got to square up with the credit on a daily basis. You have to report realized and unrealized gains and losses at year end. That's why it's easy to do summary reporting. And that's why there's no wash sales. With wash sales, with mark to market, makes wash sales a moot point. That's why you can get a simple one-page 1099-B showing the aggregate profit or loss on contracts, which you then put onto Form 6781 Part 1, and it breaks down 60/40 and then moves over to your Schedule D capital gains and losses. There's a nice nifty loss carryback election. Let's say you have a large loss for 2018 and you don't have a 475 election on 1256 contracts, which you didn't want because then you would give up the lower 60/40 rates on the gains. You don't necessarily need the 475 tax loss insurance because you got this loss carryback election baked into the cake on 1256. So you finish 2018, you have a $100,000 loss in futures. You don't have any capital gains to use up, but you say to yourself, wait a second. In the prior 3 years, I made money in 1256 contracts. So you check the box on 6781 box D, you put in the loss, then on another line, you say, I'm not taking the loss this year, I'm carrying it back. So you back it out of the current year, and then you file amended tax returns for the prior 3 years, and you get a refund plus interest. It's a wonderful carryback, and that election goes when you're filing your tax return. So when I get the calls next week for clients saying, big sell-off, I got some big losses, something melted down. I'm thinking back to February when the volatility products, some of them melted down, the inverse ones. You always want to tell a client, well, what did you lose money in? What can we do about it? What is your status? How are we going to handle it? There's more to discuss than just panicking about the loss. In the case of the futures loss, if you have a futures gain in the prior 3 years, we can get a carryback and get immediate relief. Now, let's talk about options. Let me just drink something quickly. One second. So far we covered securities, we covered futures. Options, the tax treatment is diverse. There are simple options trades or complex options trades with offsetting positions. There are options on securities. There are options on 1256 contracts. And there are options on everything under the sun. Options on precious metals, ETFs, on different types of ETFs, on volatility ETNs, on prepaid contracts. There's options on a lot of different things. And there are some commonalities to it. In general, I mean, it covers the gamut of tax treatment. They are a derivative of their underlying instrument, and sometimes they have the same tax treatment. For example, equity options, which are very popular, stock options, they are a derivative of the underlying equity, and both are taxed as securities. It's not always the case, but it generally is the case. Equity options are securities. They include equity stock options, options on the narrow base indexes, because the narrow base index was a security. Options on securities ETFs organized as a RIC, because the securities ETF was a security. So again, this common tax treatment. Now then you got your non-equity options. You remember that big capsule I talked about before? They include the options on the futures. Why? Well, a future is not an equity. So an option on a non-equity is non-equity 1256. Options on broad-based indexes. Options on commodity ETFs organized as publicly traded partnerships. CBO listed options on volatility ETNs structured as prepaid forward contracts or debt instruments. key thing is that they were CBO listed. They were not, and the ETN prepaid forward contracts were not a security. Forex, OTC options, I explained that before. So you got your simple options trades. It's like buying and selling, just call and put options known as outrights. Tax treatment for outright option trades is relatively straightforward. It's similar to reporting securities or 1256 contracts. And then you got your complex options trades, which a lot of active traders get involved with. They learn about it. There's a lot of sophisticated strategies. Most non-traders who don't know those strategies won't be able to follow what you're talking about. And that includes accountants. A lot of them are not going to understand these in full. Their option spreads, they include your multi-legged option positions like iron condors, butterfly spreads, vertical horizon, diagonal spreads, and debit and credit spreads. Tax treatment for complex trades triggers a bevy of sophisticated IRS rules geared toward preventing taxpayers from tax avoidance schemes. You remember, a lot of professional traders have gamed the system over the decades, and it's been a game of whack-a-mole, the IRS trying to find, every time they change the law, someone figures out a way to navigate around. And what traders have always done from time immemorial is put on offsetting trades to limit the risk to a minute percentage. So one way or the other, they're not going to lose money going into year end. And they're going to close out the losing trade at year end and let the profits run and hopefully game the system with the IRS. That's why they came up with MTM on 1256 contracts, which was to prevent that. But people can still do this with equity options, which are not 1256 mark to market. So these rules prevent taxpayers from deducting losses and expenses from the losing side of a complex trade in the current tax year, while deferring income on the offsetting winning position until a subsequent year. And they use the term straddles. So that's beyond the scope of today's presentation. I have covered that in depth on our options tax treatment contact in the guide, some more on the website blog posts as well. Now back to your outrights, the simple trades. There are three things that can happen. You can trade the option, close the transaction, then it's sort of like a regular equity in a sense. You got your proceeds, your cost basis. You got the option expires, it lapses. Well, it's sort of like whether it's long or short, you got zero proceeds or zero cost basis. And it's like proceeds and cost basis, but one of those is a zero. Or you exercise the option, and they're not going to let you claim that period you held the option to get a long-term capital gain. There are special rules for holding period. You'll see in publication 550 there's a lot of special rules for options, and I cover that in our content. So it's, again, the complex trades are a little beyond the scope of today's presentation. I don't want to get you lost in the weeds. Now let's talk about exchange traded funds, and let's see how we're doing on timing. We're doing pretty good. We got a lot still to cover. And Don, I assume we can go a little over 5:30. So these are your ETFs. There are securities ETFs, commodities ETFs, precious metals ETFs. And they use different structures, and there are different tax treatments. Remember, in the Commodity Futures Modernization Act, these exchanges have been competing. The futures exchanges try to put together products that mimic the securities exchanges and vice versa. And there's all sorts of flavors of these bevy of products. And it drives a lot of volatility because you have the underlying and then the derivative of the derivative of the derivative. Just kidding. It's not that to that extent. But it can confuse people tax-wise. So your securities ETFs, it's a RIC, it's a security. You sell it, it's a sale of a security. It's short-term or long-term capital gains treatment. Pretty simple. Your commodities ETFs are a little more confusing. They don't use the RIC structure. The regulators don't allow it. They use the publicly traded partnership structure. And like your master limited partnerships beforehand for oil and gas, but now you have the commodity ETFs as well. They issue an annual Schedule K-1 passing through 1256 treatment. Remember, RICs and other publicly traded securities, they're C Corps. They don't pass through anything. But the publicly traded partnership, you hear the word partnership, you think of K-1. You might get a K-1. And the K-1 may say, you have to pick up some 1256 tax treatment. You got to pay income on that pass-through income, even if you don't get a distribution for it. Now, when you sell the commodity ETF, you're not selling a commodity. You're selling still a security. It's a PTP security with short-term and long-term capital gains treatment. Okay, so you got the K-1, you pass through some income, you sell it, you got a capital gains or loss. You have to watch out to adjust the cost basis on commodities ETFs. Otherwise, you're going to double pay your taxes. If you get a K-1 with $10,000 of income that you put on your tax return and pay taxes on it, you got to adjust your cost basis to add the $10,000 to the cost basis so that your capital gain is $10,000 less. Otherwise, you have a capital gain of $10,000 more and you had to pass through a $10,000 more. If you don't adjust the cost basis, you double count. Your 1099B is not going to make that adjustment for you, and the trade accounting software, TradeLog, won't do it either. You need to manually do it. We do it for our tax compliance clients, but I'm giving you the heads up to do it on your own. All right, let's say you trade a precious metals ETF, the GLD. Well, the physically backed precious metals ETFs, they use the publicly traded trust structure. And there are some other new products that use the publicly traded trust structure, like some of your crypto ETF type products are using that. It's a grantor trust. You got to look at the prospectus for the tax treatment. A publicly traded trust, PTT, also can issue a tax reporting statement passing through tax treatment to the investor, which in the case is collectibles rate on the sales. So you might have to do, again, a cost basis adjustment. Now, when you sell the precious metals ETF, the GLD, it's like you're selling bullion. So the collectibles rate applies. What does that mean when the collectibles rate applies? It means that if you hold it for 1 year or more, sales are taxed at the collectibles rate. It's the ordinary rate capped at 28%. It's not a long-term rate because the long-term rate only goes up to 20%. It's the ordinary rate that only can go as high as 28%. So if you're in a tax bracket, if your ordinary bracket is less than 28%, it doesn't matter whether it's short-term or long-term for you. So if you're holding on to precious metals going into your end, waiting for 12 months and you're in a lower rate, you may as well just sell. It's going to be the same rate. Now, options on ETFs, the IRS has not given explicit tax treatment. Our position is that options on a securities ETF is a security. So the options on the ETF RIC is an option on a security. But if it's an option on a commodities ETF PTP, we think it can be 1256, and the options on the GLD can be 1256. All right, now I don't know how many of you trade forex. That's when you trade in the interbank market. Some of your securities and futures brokers also are forex dealers. Many are not. You can get the best of both worlds if you do things right. Ordinary loss treatment on the default 988, where you can elect capital gains treatment to get lower 60/40 rates on 1256G. So forex transactions start off receiving ordinary gain or loss treatment as dictated in 988, because that's what manufacturers do. It's an ordinary part of their business. You lose a lot of money, you have a job income, you might like not having the capital loss limitation. If you're an investor or a trader, not a manufacturer, but an investor or trader can file an internal capital gains election in your own books and records to get capital gain or loss treatment instead, which you might want if you have a capital loss carryover and you want to use it up. You can make or retract that election on a good to cancel basis at any time during the year. If you're trading the majors, there's a way that you can navigate into the lower Section 1256G, 60/40 treatment. This is for forwards, and we make a case for spot too. So you file that capital gains election, and on the major currencies for which U.S. futures trade on futures exchanges, same pairs trade, you can get the lower 60/40 rates. It's very nuanced, it's uncertain, it's complicated. You need to read my blog post about it on the website. So in the tax center, you go to the tax treatment, you go to forex, you click through the links. Forex tax reporting and summary reporting. If it's 988, it's realized gains or losses. If it's 1256, it's mark to market. The broker doesn't give a 1099-B on spot forex, but they do give good online tax reports. I covered forex quickly because I'm not even sure if TradeStation offers that, and maybe a lot of you don't trade forex. I have other content that's just on forex. You can find that on our website. Let's talk about other financial instruments, which are much bigger than the catch-all other of foreign futures, precious metals, volatility products, including exchange traded notes and swap contracts. We touched on these earlier, cover them a little bit more. Foreign futures, they're getting more and more popular. People like to think, oh, if it's a future, it's 1256, but it's probably not. Futures contracts listed on exchanges located outside the U.S. are not 1256 contracts by default. Now, some foreign futures exchanges applied for and received a no-action letter from the CFTC permitting them to market to U.S. customers. And there were some foreign exchanges like the one in France and some other countries that advertised that on their website and led some of the top brokers in those countries, I don't want to name names, to say that because of that, they had 1256 treatment. And we had to correct them that, no, you don't. You have the first leg of achieving that, but you have to go a step further. The Foreign Futures Exchange needs to apply for and receive an IRS revenue ruling granting 1256 tax treatment. Only a handful of exchanges have that 1256 treatment. You can see a list, click the link on our website. You can just find your way to the foreign futures content through the tax center, financial products area, and you'll click on a big blog post that lists all the exchanges. They include Eurex, Life, ICE Futures Europe, ICE Futures Canada. Right, precious metals, we touched on this earlier with the ETFs. It's the collectibles class. If you hold collectibles, which also include coins or stamps, Bitcoin is not collectibles. This is your bullion. And some publicly traded trusts that are based on bullion because they're look-through entities. They look through to the underlying tax treatment. So if you hold collectibles over a year, it's taxed at the collectibles tax rate. Again, it's ordinary rate capped at 28%. If you hold it 1 year or less, it's just a short-term capital gain at the ordinary rate. Volatility products is a big area now. There are many, you can trade volatility, and if I look, most days I look at, it's up 10%, it's down 10%. I mean, these are big swings. It can be very dangerous. And I can tell you that I've had some clients make and lose fortunes on volatility products. And it's a shame when you lose a fortune and you don't have ordinary loss treatment with trader tax status in 475. And then you get stuck with a huge capital loss carryover. And it's not a 1256 loss carryback election either. Now, there are many different types of volatility-based financial products to trade. Again, every exchange tries to come up with it in a different flavor to capture business. For example, the CBOE Volatility Index, the VIX, the VIX futures, they trade on the CBOE. It's a regulated futures product. It's a 1256 contract. You're going to get lower 60/40 capital gains rates. And if you have a 1256 loss, you can do the 3-year carryback election but only against the 1256 gains. Well, that sounds pretty good to me as a tax product right there. It's got the 60-40 on the upside, and it's got the carryback election. And remember, with 1256, you can, if you're a trader, elect 475 on commodities. Usually you elect on securities only, but you can elect on commodities too. So that seems like a pretty good product. Then you got the New York Stock Exchange. Well, that's a securities exchange. So you're thinking, well, is this going to be a security? The SPXY, and there's a lot of other ones like it. It's an exchange traded fund, an ETF. Bingo, you think right away, ETF, securities, it's a security. So you're going to have, if it's a security, you got wash sale issues. If you got a 475 election, you're going to have ordinary loss treatment. That's going to come in really handy if you have a big loss. If there's income, you're paying the top ordinary rate. Then you got the iPath S&P 500 VIX short-term futures. Wait a second. It says futures, and it's an ETN. Is that a future? No, it's not. It's not a future. They tricked you. It's an ETN. It's probably a prepaid forward contract or a debt instrument. And in the case of VXX, I can tell you it's a prepaid forward contract. That's not 1256. That's not a security. You can't use a 475 election loss. You can't use a 1256 loss carryback election. You're stuck with a large capital loss if you have one. And if it's income, it's ordinary income. So many issuers structure volatility ETNs as prepaid forward contracts, which provides deferral of taxes until sale, the realization method, long-term capital gains and losses, or short-term. So far, it's sort of like a security, but it's not a security, a prepaid forward contract. That means it's not subject to wash sale loss adjustments. Well, that's good. If you take a big loss going into year end and you buy it back in January to catch a rally, you don't have to worry about wash sales. And I wouldn't do that purposely. You never know when the IRS may change their tune. But right now, I can tell you if it's not a security, it's not a wash sale, because wash sales are for securities only. Now, if you have the 475 election, you're out of luck on the ordinary loss treatment. A lot of traders in February, when they got to me with the meltdown on the VIX products, they were really upset to learn that they couldn't get the 475 treatment, which they had duly elected. Now, if they were trading the UGAS, that is a debt instrument. It's not a prepaid forward contract, and a debt instrument is a security, so it should be wash sale losses and or 475 if elected. So good if you have 475, bad if you have wash sales. Now, again, you remember I talked about the CBO listed options on these volatility ETFs and volatility ETNs, and we think they're non-equity options trading on a qualified board or exchange, so we think they're 1256, which is great because 1256 is 60-40 on the upside, and you got your 1256 loss carryback election. So if you're factoring taxes into what you pick to trade, this is a good webinar to go over and share with your friends. Let's talk about swap contracts, and we're kind of finishing up here, and we're going to get to questions. Not too many traders trade swap contracts, but you might have access to it. Well, those are ordinary gain or loss swap contracts, because that's what a lot of manufacturers might trade those for hedging purposes. If you happen to trade NADEX contracts, NADEX gives you a 1099-B. They have historically. We've had a bone to pick with them about that. We don't think that they say they're binary options. There's no optionality. They're not options in our research. They're not a qualified board of exchange for 1256. They may be a contract market with regulation. So we don't think they meet the requirement of 1256, but they keep issuing these 1099-Bs as 1256. And if you have a big gain, you may want to go with that. But if you have a big loss, and I'm not saying you should, if you have a big loss and you're trading NADEX contracts and currencies, we think there's grounds to use ordinary loss treatment, not 60-40 capital gains. Let's talk about cryptocurrencies. I'm sorry, we had this one more area, and then we're going to finish up. So we are going to go to 5:30 plus. Crypto was all the rage last year. People made a fortune. A lot of them didn't pay taxes. They did all coin-to-coin trading. They said it was a like-kind exchange. They deferred the big income to this year. Market melted down. Most of your crypto value is IRS money that hasn't been paid. It wasn't paid for April 15th. People want it on extension. They have to pay it by Monday. A lot of them probably won't pay it by Monday. That's been putting a lot of pressure on crypto. If you look at it as a U.S. instrument, I don't know if the same tax type thing went on worldwide. That's a little commentary there. If you sell, exchange, trading other coin, use crypto to buy something, which few people do. That was the original promise. Oh, it's digital money. It's very inconvenient digital money. It takes a long time and it's expensive. It's not so digital like PayPal or Square or others. It's got the promise of that one day, but it's not there yet. Most people are holders or they're trading. And they got to square up with the tax man. A lot of people have not squared up. I did a tremendous number of consultations. They didn't follow up with us for tax compliance. I think that the unreporting is rampant. The IRS is lowering the boom. It's intangible property. Cryptocurrency users may call it digital money, but it's not sovereign government issued money. Every time you use dollars to buy something, you don't have a capital gain because you used your dollars. My dollars went up the last few days because as a safe haven. But does that mean that I have a capital gain? No, that's ridiculous. But the fact that crypto traders have to pay taxes on every use of it, it puts a chilling effect on digital money. Is the federal government using that to slow it down? Probably. Now, the SEC labeled some ICO tokens as securities. There's been crypto everything, ICO everything. Well, it's been a hot commodity to misuse the term commodity. So some of those tokens might be securities, but the SEC did say Bitcoin and Ethereum, the two biggest ones, are not securities. And some CFTC officials have called cryptocurrency a commodity. Good for them. That doesn't drive what the IRS calls it. The IRS calls it intangible property. And that has a lot of implications. So there's capital gains and losses on intangible property. If you invested in cryptocurrencies and sold it, you flat out, you bought Bitcoin, you sold it for cash, for fiat. Or you exchanged it for altcoin. You bought Bitcoin and used your Bitcoin to trade a whole long list of altcoins. And back and forth, and then finally back to Bitcoin, and you still haven't gone to fiat. It's all capital gain and loss transactions. Well, let's say you use some Bitcoin or other coin to buy something, a vacation, a boat, a cup of coffee. It's all taxable, so I call it coin-to-currency sales, coin-to-coin trades, purchase of goods or services using coin. Now, there are other transactions that might require current taxable income. Chain splits or hard forks might require ordinary income recognition if the holder has control over the new cryptocurrency in their wallet and at an exchange. So your Coinbase exchange may not recognize it right away. You may not have dominion and control over it right away, or you might. And if there is a fair market value supported by trading right away, then hey, if someone handed you Bitcoin Cash and your broker supported it, Coinbase did not from day one, but they did before the year end last year. You got Bitcoin Cash and it traded at 267, you probably have taxable income for it. But if you didn't have dominion and control and or there wasn't a fair market value, then maybe you could defer income until recognition. That's quirky. I could understand some, debate about those issues, but not coin to currency, not coin to coin, and not coin usage. So you have to impute income. The big problem for the IRS is that many crypto transactions are not evident for tax reporting. There's not a clean set of 1099s from hundreds of brokers around the world. when you look at the US brokers, a lot of people were surprised to get a 1099K like from Coinbase for 2017. But for most of their coin wallets, they're not getting a 1099. And it may not include coin-to-coin trades or hard forks chain splits or using it for purchase of goods or services. But you have to impute income on all those things. You need a great software that accounts for everything under the right accounting method. You have to impute sales or exchange on all these items. Now, there's a big problem with like-kind exchanges. I think the IRS really messed up here. They let it go last year. They never issued the guidance. A lot of people did the coin-to-coin trading, and they never paid taxes on the millions they made last year. And I think they should have, because I don't think it was a like-kind exchange. I don't think Bitcoin is like-kind property with Ethereum, and I don't think that Coinbase and the other exchanges met the requirements of 1031. And now, by the way, so it's a debatable point for 2017, but it's a moot point for 2018 because tax reform said very clearly that you can only use 1031 deferral for real property only. So, you know, you own a commercial building or you sell it and you use those funds to buy a replacement similar property, and it's pretty you know, like-kind property is very liberal in the real property space. You know, gold is not like-kind property with silver coins. Some gold coins are not like-kind property with some other gold coins. So I don't think Bitcoin is like-kind property with Ethereum. That's last year's business. This year, moot point. Everything is taxable coin to coin. So a lot of coin traders are not used to squaring up with their partner, the IRS, and they're gonna be a rude surprise because those 1099s went out. The IRS busted Coinbase with the John Doe summons. They have the names of the people. They're auditing them. This is like the offshore bank accounts. So they don't issue it to everyone. You have to meet the requirements of the 1099K reporting, which was similar to what they got on the John Doe summons. And you can click through the links on our website to see what that was. So we covered it all. We talked about securities. We talked about 1256 contracts, options, ETFs, forex, precious metals, ETNs, foreign futures, crypto. So come over to the website, give us a call, not today. Our team is tied up with the October 15th deadline for 2017 tax returns, which is Monday. So that's the real April 15th. I can do this because I don't work on the tax compliance team. My partner, and thanks to him, Darren Neuschwander and Adam Manning, my other partner, they run that part of the business. They do a great job. And they've been extremely busy this year with all the crypto, with all the new tax law. And every time the markets are volatile, there's new traders coming in. So it's a very active area, I can tell you. So you want to come over to our website. And if I show screen sharing now and my monitor, so you should see, Don, do you see the tax treatment now? Do you see the website, Don? So I assume that you do. Yes, it looks like you do. Let me go back to it. Okay, 1 second. All right, so you come to the website, go to GreenTraderTax, click on Tax Center, scroll down, Tax Treatment on Financial Products. That's what we did today. And you look on this main page here, and you see that tax treatment affects investors, retail business traders, prop traders, hedge funds. Sadly, a lot of tax preparers overlook these minor differences. It's essential that you learn it all. Now, you might expect that your 1099B would handle all this, but 1099Bs are prepared for the everyman. They're not supposed to give you one for 475. They may pick up the tax products definitions from the exchanges. They may say something is a security when it's 1256 or vice versa. You got to go further. If it's securities, remember again, you need the tax software for the multiple accounts. Next is an ordinary or capital gains treatment. A lot of instruments are capital. Some are ordinary. So look this over and then go over to these pages. Like for example, if you go over to 1256 contracts, remember I told you could scroll down and see the brackets. So you can see right here, these are the 60-40 brackets for 2018, right here. So let's say you're in the 22% bracket, your 60-40 rate is 17.8. It's a nice savings of 4.2%. In the lowest bracket, it's 4% versus 10%. This is the savings in this last column. The highest savings is 12% when you're in the 35% bracket. Now you also can go over to the events page to look over past webinar recordings. And you can scroll down, there's a lot of those. And you can go to the blog, and on the blog you can always click on financial products tax treatment on financial products, and you'll see all sorts of blog posts. And you'll see like these were some of the detailed ones on ETNs. Remember I talked about those? These are the most popular ETNs. It shows you right there which are the prepaid, which are the debt instruments. So these are blog posts that delved into tax treatment, and you want to focus on that area. And then when at the end of the day you have questions, go over to consulting, click on a consultation with me, get on my schedule, and have a 45-minute session with me. And I'll answer your questions and cover a lot of other things. So let's look if you have any questions today, if we still have time before closing out. And Don, you can jump in at any portion at any time. Let's go back to the slides and let's look at your questions here. So I'm scrolling up to the top. I'm not going to get to all the questions. Edward W., what is the latest for LLC, TTS, all that? Now, you got to get the entity open next week, the TTS going. If you start mid-November, it's too late to claim TTS. So the entity strategy is starting to close out. And then you want to focus on a Jan 1. TradeStation should have the recording. Thank you for your nice comments, people. If you trade only in your IRA, you don't have to worry about the WAR sales. You don't have much to worry about the taxes at all. If you don't have trader tax status and you have a bunch of IRA money, especially a Roth, trader tax free for life. Don't have to worry about any of these things. You're not going to get 60-40 treatment, but in a sense, you're getting a benefit from your losses if you're in a traditional retirement account that's not a Roth. If you lose money, there's less money to take out in retirement. So in a sense, you are getting the benefit of your losses. And I have contents about that when I've written about that topic. Someone else, do we need to report capital gains for each leg of multi-legged? Yes, the complex trades, you need to do the reporting. Check out how TradeLog handles it. But TradeLog is not going to do the complex straddles that you're in. You're going to need to manually do that. That's why I like my active complex options traders to have trader tax status in 475, so we don't have to worry about the straddles. Let's keep going on the questions here. Cost basis, you want to use TradeLog for that. Your broker keeps track of cost basis. Remember, your 1099-Bs have changed a lot since 2011, since the cost basis regulations were phased in over 3 years, and it actually took even longer than that. They have been fully phased in, but they're still apples and oranges, and that's why you have to go further with it. And that's why you need the software. VXX, yeah, I already said that, yes, prepaid forward contract, right? And I showed you that blog post about it. For 2019, you get your TTS going, your 475 from day one. Yes, you can do that. The 475 election as an individual is by April 15th, 2019. If you do a Roth conversion, you pick up the ordinary income, and then you can't do a reversal anymore. You're stuck with the conversion. I don't see any other questions. It looked like I got to all the questions. If I missed your question,
You know what, Bob? I think you did get to all the questions that were in there.
Good. Well, I'll say goodbye to everyone. Thank you for coming, everyone. I'll go back to you, Don, to close up.
Thanks very much, Mr. Green. You were awesome, and you could not have been more specific on the hard parts. And now we have another resource for all of you that are attending, that the GreenTraderTax Tax Center can absolutely be a helpful tool for you moving forward. I want to thank everybody for spending time with us today. Your time is valuable, and so we hope that we helped you make good use of it here with this presentation. I think that it was very beneficial. As I mentioned early in the before we started, we will be we have recorded this event. It will be in the TradeStation University page sometime tomorrow. Also, if you're a TradeStation customer, you'll be able to view it on TradeStation today. So, having said that, have a great night. We'll see you again tomorrow for the morning market briefing. 1/2 hour before the market opens, join us at TradeStation for tomorrow's morning market briefing.